Welcome to The Explainer. Today, we are zeroing in on the ultimate test of a financial analyst, translating hours of grueling data collection into a single, concrete decision. Think about the reality of this job for a second. It's those late nights illuminated only by the glow of three monitors, sifting through endless spreadsheets, parsing complex regulatory filings, and building these massive financial models. We spend so much time talking about how to tear a company apart, look at its gears, and map out every tiny moving piece. But we rarely talk about the absolute hardest part of the entire job, how to put it all back together to make a final call. Okay, so let's dive into this. You've traversed the treacherous landscape of banking metrics. You've looked at net interest income, you've scrutinized asset quality, checked capital adequacy ratios, evaluated management's credibility, all of it. But what do you actually do with all that data? Just having a spreadsheet full of numbers isn't an analysis. Honestly, if you stop there, it's just glorified data entry. You've essentially just reorganized facts that were already public. The real magic and the actual tangible value of you as an analyst lies entirely in what happens next. Because the reality is, all those disparate data points from the previous 10 steps of a rigorous banking analysis, they are entirely useless unless you can compress them. Imagine going to a doctor who runs 100 different blood tests, walks into the exam room, silently hands you a 50-page stack of lab printouts, and then just walks out. You'd be furious, right? You don't want or even know what to do with the raw data. You're paying for the diagnosis. Well, it is exactly the same in financial analysis. Clients don't pay analysts for spreadsheets. They pay for the verdict. Your data means absolutely nothing without a decisive, synthesized conclusion. And that brings us to the ultimate synthesis point in our professional framework. Step 11, write the verdict. Just think about the sheer weight of what you've evaluated up to this very moment. You've analyzed the macroeconomic context, dissected the spread, scrutinized funding structures, modeled asset quality, projected the trajectory. You've questioned the profit quality and evaluated efficiency, returns, capital, management, and valuation. It is a lot. But after processing that absolute mountain of distinct, complex variables, you finally arrive at this exact stage. You must pull every single thread together into one clear, unwavering decision. So, what exactly is it? The verdict is a single judgment pulling together all analysis to make a clear investment decision. The crucial point here is that you must force all your extensive research through an incredibly tight funnel to produce one drop of pure actionable insight. It's the definitive filter that separates the noise from the signal. For example, a beautifully formatted 20-page report detailing a bank's sleek new mobile app features? Yeah, that's just noise. A single sentence noting that their core deposit base is shrinking while their cost of funds skyrockets? Boom, that is the signal. You aren't just summarizing what the bank does, you are explicitly stating what an investor should do about it. To achieve that level of clarity, you cannot just guess or write some vague summary. Your verdict must explicitly state 5 exact elements. First, you must establish the overall quality of the bank. Second, profit repeatability. Like, is that recent profit jump genuine, core-driven growth, or just a temporary illusion from falling provisions? Third, you have to identify its single biggest strength. Maybe it's an incredibly cheap CASA funding base, that highly desirable, low-cost mix of current and savings accounts. Fourth, you must name its single biggest risk or watch item going forward, like rising slippages, loans quietly going bad under the surface. And finally, valuation attractiveness. Is the price actually fair given its returns? Now, there is a massive difference between amateur cheerleading and professional analysis. A good verdict is relentlessly honest about what could go wrong, not just what looks good. It's a very well-documented psychological phenomenon, essentially confirmation bias, that it is human nature to fall in love with a company after you've spent 40 hours deeply researching its strengths. You naturally want it to be a winner because, well, you found it. But a professional verdict actively fights against that instinct. It actively seeks out the blind spots and demands that you publicly document the downside. Which brings us to a harsh but necessary reality check when evaluating your findings. If the core engine is strong, asset quality is clean and improving, returns are high and genuine, management is credible, and the price is reasonable, you undeniably have a strong candidate. But a weak candidate falters on any of these legs. A bank is a fragile, highly interconnected ecosystem. It isn't just a collection of independent metrics. If one vital pillar wobbles, it threatens the entire structure. For instance, a remarkably weak capital pillar will eventually and inevitably crush the asset quality pillar when economic stress hits. Your final verdict must objectively reflect that structural fragility. I really want to emphasize this because it is precisely where most analyses fail. often with catastrophic consequences. You have to stop and ask yourself with absolute sincerity, are you ignoring a glaring red flag just because the profit margin looks nice today? Financial history is literally littered with the dramatic collapses of major banks, all because analysts ignored fatal flaws hidden behind impressive short-term yields. Maybe the return on equity is fantastic, but if it's built entirely on a dangerously thin capital adequacy ratio and heavy, unsustainable leverage, you can't ignore that. If any leg is weak, you cannot gloss over it in your final write-up. The verdict must act as an unforgiving mirror, reflecting the ugly truths just as clearly as the beautiful ones. Once you've weighed those strengths against the risks and laid out your 5 ingredients, you have to stake your claim. You must assign a specific rating, lean, based on your conviction. Are we looking at a clear buy, where the fundamentals and the price align perfectly, or perhaps a conditional buy, which, by the way, is actually where analysts really earn their money? A conditional buy means you identify the exact trigger needed for success, like waiting for a specific drop in the cost-to-income ratio before committing capital. Maybe the fundamentals weren't an accumulate, where you build a position slowly over time, or simply a hold if the upside is fully priced in. The one thing you cannot do, you cannot sit on the fence. You have to commit to one of these stances. And here is the ultimate challenge of Step 11. It sounds incredibly demanding, but the mandated output for this entire, rigorous, multi-hour process is just a single paragraph. That's right, one paragraph. In financial analysis, brevity equals mastery. Honestly, it is surprisingly easy to write a 10-page, meandering conclusion that covers every possible scenario but says absolutely nothing definitive. But writing 4 precise sentences that accurately capture the future trajectory of a multi-billion-dollar bank, that requires true conviction. The constraint of length forces absolute clarity of thought. In that one paragraph, you cannot afford even an ounce of ambiguity. You must explicitly plant your flag with a clear rating and immediately follow it by plainly stating the key risk. If a portfolio manager or a client scans your concluding paragraph and doesn't know exactly where you stand or exactly what specific event could blow the entire thesis up, well, you haven't done your job and you need to rewrite it. It is all about total, uncompromised accountability. Because ultimately, the numbers just tell the story of the past, but making the final call writes the future. You've mapped out the net interest margins, you've checked the provision coverage ratios, and you've weighed the price to adjusted book value. But the ultimate question remains. Can you distill hours of complex financial analysis into one brutally honest paragraph? The next time you're buried under a mountain of balance sheets, ask yourself, are you just collecting facts, or are you ready to write your verdict?